Hello traders, Gary Wagner here just after 11 o'clock in Honolulu, 5 o'clock in New York on Monday, the 18th day of August, 2014, and this is the daily report for gold and silver. With the market now closed for the afternoon break, it appears as though we have closed on the lows in gold, 1297.12 our current print with the low at 1295.10, a high of 1304.80. Silver did eke out a small gain, the only one out of the precious metals complex to do that, up approximately 4 cents on the day, 1957 with a low of 45, a high of 1980. More on silver towards the end of the show. So what can be made really of today's market activity in which we're really seeing a continuation of the selling that began in the market on Friday? We're looking at a daily chart to start the show off today, and a couple of things become real apparent. We did have resistance. We talked about the highs up at around 1317. That is an important number, and 1320, of course, is one of the fib numbers that we're looking at. But just by looking at this chart, of course, again, a daily chart, let's go ahead and try to blow this up just a little bit. It's a daily chart, and when we look at this upper level resistance, what we see is as follows. The real resistance that I'm noticing comes in, and this number has been around a multiple amount of times, which is roughly the 1311 area. It's a 38% resistance from the larger move up here. And when we go in and plot it, we can see a series of highs. However, at the same time, we do not really have any of the real bodies. Now, again, in candlesticks, the key distinction between that and a bar chart is that this rectangle, the rectangle is really the relationship of the open to the close. So that if it opens and closes higher, it's green. If it opens and closes lower, it's red. But the key that I want to really kind of hone in on is this real body, because the real body takes, when you account for where it opens to where it closes and disregard the highs and the lows, you get a more real sense of the real trading range rather than the extremes on the highs or the extremes on the lows. And when we look at this particular chart, we have almost all of the bodies that have maintained just below this resistance area, although we did get some highs, which brings to my point the following pattern that we can uncover. Simply put, it is called a scouting party. And on a scouting party, this was identified, or the phrase was coined by Steve Nissan, one of my mentors, a great candlestick expert, but it is not a candlestick pattern. It is an observation that he made, and I think it's a very, very acute one, and that's why I present it to you today. As a market begins to move up, in a pattern called a scouting party, what you'll start to see is highs moving above resistance, not necessarily the bodies, but the highs. And what it is according to Steve Nissan, it is the bulls testing the fortitude of the bears. So every time the market hit these extreme highs, you did get selling coming into the market, which is what brought it off the highs back into these bodies and back into these ranges. And so it was unable to form what is called, in his term, a beachhead. What happens on a beachhead is, rather than seeing these two red candles here, on a beachhead, what you would really get is you'd get these series of highs, the market would come back below resistance, but then you would start to get some real bodies, such as this, that begin to trade really above that particular resistance area. He calls that a beachhead. And then once you get that, you realize that the bulls have tested the fortitude of the bears, and the bulls ended up victorious in this particular kind of event. However, that was not and is not the case in terms of what we're looking at, because what we're looking at is an unsuccessful scouting party. In other words, the market came up, tested the fortitude of the bears. They wouldn't really let the market run higher. So the real question is, well, what are we going to look at? So what we really have to look at in terms of our current model, now realize we did have a protective stop in the market. We got in at 94, we got out at 98. We picked up a couple of dollars on our last trade. So the market is below where we got out, but now what comes into real question is our current model, because our current model is looking at our A, our B, final C. This concludes our intermediate 2, and our current model puts us in an intermediate 3. Of that intermediate 3, it's our current belief that we finished 1, 2, and we're now in this third wave, all a component of that one wave we just mentioned. Now, here's what becomes critical. Of course, if we are in 3 of 3, and there should be 5 of 3 to conclude this particular wave count, but for this model to hold some sort of weight right now, there's no doubt we'll see the market run through a series of waves. 1, 2, 3, 4, 5. I have no worries about that. My concern, of course, is going to be the termination, because 1290 is a 76% retracement of this most recent rally here. In other words, if I go ahead and subdivide this particular market right in here for our 5 count, if we go ahead and subdivide it, of course, we're going to get a 1, 2, 3, 4, 5. But this second wave 2 really can't dip much below a 76% retracement for the model to really hold any kind of weight. Now, the fact is we're trading roughly at 97. That's $7 off of that low. We did touch upon that low in Friday's trading. And that's right here. The chart that we're looking at, of course, is a half-a-day chart. I've broken it up so we get a better idea of this subcount. But as far as I'm concerned, it is really, really important that we hold this particular, call it, line in the sand, so to speak. Now, with that in mind, if you recall from Friday, I said if we find any kind of support, we're probably just going to go and re-enter the market. In other words, I was not looking for our first subdivision and our first corrective wave within the subcount. However, the one thing that you have to really put a lot of credence or weight on is the fact that wave 1 is our benchmark wave. And what I mean by that is we use our benchmark wave to really ascertain or to predict where we're going to see wave 2 go, because that's going to be roughly a 61% retracement of wave 1. Then once that concludes, let's assume it concludes here, when we analyze wave 3, we do this by comparing it to that of wave 1. Wave 3 cannot be the shortest of any of the impulse waves, so you'll roughly get at least the same move that you saw in this wave 1 right in here. Secondly, it's typically comes in at either the 38% retracement level, the 23% retracement level. So it's usually 123, 138, that of 1, up to about 161 of 1. So you will typically see the market move. And then again, so we've used 1 to really benchmark 2 and 3. Now 4, we do use wave 3 because we'll say that the retracement of 3 should be so much. And then wave 5, again, that last wave is usually equal to that of wave 1. So we go ahead and we compare wave 1 and 5, wave 1 and 3, wave 1 and 2. Now, that being said, there's nothing that really gives us a benchmark of wave 1. So until wave 1 is complete, we're really in the dark in terms of any kind of eloquent model to follow. There's other things that we'll do. We'll compare it to a previous one. We'll look at ranges and things of that nature. We'll also look at candlestick patterns to determine when we hit some kind of a tentative top. But that's why this wave 1 is so important, and without a question of a doubt, the hardest to predict. So for the time being, we will be staying flat, no position in gold. Now, of course, silver. Silver has been in a world of its own. It's not trading in accordance, or in tandem, I should say, with gold. It has been trading in a unique way, and it's not been following or piggybacking any of the recent moves that we've seen in gold. As gold moved up, silver continued to move down. Now we have gold moving down and silver moving up. Couple of interesting things to note, and we'll just kind of call it a day with those two things. First of all, when we look at the recent retracement in gold, it came past 61%, but not quite to 76%. Traders, are you noticing any similarity there? And the second thing is the fact that we are in this mid-range between 61 and 76%. Really doesn't give me some solid sense that we can look for support here. Now, if we look at these series of tops right in here, that is about the only thing that I can see in terms of pegging some sort of resistance or support, and we're trading just under there. As I said before, I really wanted to see the market move above $20.10 before I felt comfortable. And of course, I said that when the market was still trading roughly at around 1278. It's much lower at this point. So the question is, will it find support in this area? If not, as I said last week, the market will probably drift to 1935. We'll keep our hats on, we'll sit in our seats, and we'll see what follows as the week unfolds. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.